What if the safer investment people trust the most is not always the one that grows your money faster? Why you should keep watching. In this video, we are not guessing. We are breaking down the real numbers behind real estate and stocks in a very simple way. You'll see how both investments actually grow money, what hidden costs people often ignore, and how the math changes depending on your time, risk, and starting amount. By the end, you will clearly understand which one may fit you better, instead of just following what others say. Let's keep it simple and go step by step. First, what are we really comparing? Before we talk about money, let's first understand the basics in a simple way. Stocks. When you buy stocks, you're buying a small part of a company. Think of it like owning a tiny share of a big business. If that company does well and grows over time, the value of your share can also grow. One of the biggest advantages of stocks is that you can start with very little money. Even a few dollars is enough to begin in many cases. This makes it easy for almost anyone to get started. Another important point is flexibility. You can usually buy or sell stocks quickly through a trading app or platform. So, if you need your money, you can access it without much delay. Real estate. When you buy real estate, you're buying something physical, like a house, apartment, or land. It is a real asset you can see and touch. There are two main ways you can earn money from it. The property value may increase over time. You can earn rental income every month. However, real estate usually requires much more money to start compared to stocks. It also takes more time and effort. Selling a property is not instant. It can take weeks or even months, depending on the market. Now let's talk about the real math. This is where things get interesting. We will look at a simple example. Let's say you invest $10,000. 1. Stocks growth. Example. Let's assume the stock market gives an average return of about 8% per year over a long period. This is not guaranteed every year. Some years, the market may go higher, and some years, it may go lower. But over many years, people often use 8% as a simple average to understand long-term growth. We can use a basic compound growth formula, A equals P times 1 plus R to the power of T, where P equals initial investment, $10,000, R equals 0.08, 8% yearly return, T equals number of years. What happens after 10 years? Your money grows step by step each year. After 10 years, your $10,000 can become approximately $21,589. You did not add any extra money in this example. The growth comes from compounding, which means you earn returns not only on your original amount, but also on the profits that were already made earlier. After 20 years? After 20 years, the same $10,000 can grow to about $46,610. That's the power of long-term compounding. The growth starts slow, but it becomes much stronger over time. Important point. The key thing to understand is this. You didn't need to actively manage anything. No tenants, no repairs, no daily work, just time in the market. However, it's also important to remember that this is based on averages. The market does not move in a straight line, and returns can vary each year depending on economic conditions. 2. Real estate example. Let's say you use the same $10,000 as a down payment on a property worth $100,000. This is a simplified example because in real life you often use loans. Assume property grows 4% per year. You rent it out. You have loan payments, taxes, and maintenance costs. Now, here's where real estate becomes different. You don't just earn from price growth. You also earn rental income. Let's say you earn $600 per month rent. That's $7,200 per year. But you also pay maintenance taxes, insurance, possible empty months. Let's assume costs reduce your income by 30%. So net rental income, around $5,000 per year. Property value growth, A equals P times 1 plus R times. T, A equals P times 1 plus R, to the power of TA equals P times 1 plus R times T, where P equals $100,000, ER equals 0.04, 4% yearly growth, T equals time after 10 years, about $148,000. Now add rental income. Over 10 years, $5,000. Times 10 equals $50,000. So total gain, property growth, plus rental income equals around $98,000 profit. But remember, you only invested $10,000 up front, but also likely took a loan. So, which one looks better? So far, at first glance, real estate looks stronger, but not so fast, because we are not done with the real math. Hidden factor number 1, liquidity. Stocks, you can sell in minutes or seconds. Real estate, it may take months to sell a property. This matters when you need cash fast. Hidden factor number 2, effort. Stocks, mostly passive, very little work. Real estate, tenants, repairs, legal issues, management decisions. Even if you hire someone, you still manage the risk. Hidden factor number 3, risk type. Stocks, market goes up and down daily, but diversified portfolios can reduce risk. Real estate, property prices can stay flat for years. Location matters heavily. One bad tenant can create problems. So risk exists in both, just in different ways. Quick question for you. If you had $10,000 today, would you feel more comfortable investing it in a company you trust or buying a small piece of property? Think about that for a moment. Now, let's talk about leverage. This is where real estate gets powerful. Leverage means borrowing money to invest. In real estate, you put $10,000, bank adds $90,000. You control a $100,000 asset. So even small price changes affect your return. If property increases 10%, you gain $10,000 on your $10,000 investment. That is a 100% return in this simple example. But if prices fall, losses can also feel bigger. Stocks also have leverage, but different. In stocks, you usually invest your own money, but compounding plays a big role because returns build on top of previous returns. Over long time periods, this effect becomes very strong. That's why many people use stocks for long-term wealth building. Here's something interesting. Most wealthy people don't choose only one. They often use both stocks and real estate. So let me ask you, do you think diversification is more important than picking the perfect investment? Tell me what you think. Time changes everything. This is the most important part. In the short term, real estate can feel more stable. Stocks can feel more unpredictable. In the long term, stocks often grow steadily through compounding. Real estate can build wealth through leverage plus rent, but both depend heavily on time discipline, market conditions. There is no instant win. Simple real-life example. Imagine two people. Person A invests $10,000 in stocks, leaves it for 20 years, does nothing else. Person B buys a rental property, manages tenants, deals with repairs, uses leverage. After 20 years, both may have strong results, but their experiences will be completely different. One is mostly passive. The other is active and hands-on. So which one makes more money? The honest answer is, it depends on how you use them. Stocks can grow strongly through compounding and consistency. Real estate can grow strongly through leverage and rental income. Neither is automatically better. The real difference comes from your patience, your risk tolerance, your ability to manage complexity, your starting capital. Final thought. If you are someone who prefers simplicity, flexibility, easy access, stocks may feel more comfortable. If you prefer tangible assets, monthly income, long-term control, real estate may feel more attractive, but both require time, and both can grow wealth in different ways. If you enjoyed this breakdown, you might also like learning how compound interest actually builds long-term wealth in real-life scenarios. It's simpler than most people think, but very powerful when you understand it. If this helped you understand the real difference between real estate and stocks, consider subscribing for more simple finance breakdowns like this. And check out the next video where we break down how people actually build their first $100,000 step by step. Thanks for watching.